Good evening, I'm Mike Knetter, and welcome to the UW Now Livestream series, where we bring you experts from the UW community to talk about timely and important topics. A recent survey of business economists predicted labor shortages and persistent inflation for the foreseeable future. Other observers, including some at the Federal Reserve Board, see the recent uptick in inflation as a largely temporary phenomenon due to pandemic adjustments. So which is it? And how do consumers, investors, businesses, and policymakers make decisions in a world with this degree of price level uncertainty? Joining us tonight is an all-star cast to discuss the causes and consequences of inflation. We have with us Dana Peterson, the chief economist at the Conference Board, Mike Stohler, the incoming Chief Investment Officer at the Wisconsin Foundation and Alumni Association, and Noah Williams, the Director of the Center for Research on the Wisconsin Economy and Professor of Economics at UW-Madison. Thanks for being with us tonight to discuss this really important and hot topic. Kicking us off tonight is Dana Peterson, who received her Master's of Economics at UW-Madison and is currently Chief Economist and Center Leader of the Economy, Strategy, and Finance Group at the Conference Board, a 501c3 nonprofit business membership and research group that conducts economic and business management research. Her research covering rates, equities, credit, foreign exchange, commodities, and asset allocation has been featured by U.S. and international print and broadcast news outlets on a regular basis. Prior to joining the Conference Board, Dana was a North American and then global economist at Citibank, and prior to that, an economist at the Federal Reserve Board in Washington, D.C. Dana, I'm sure your members at the Conference Board think this is an incredibly important topic, and you've probably spent a lot of time following this. Thanks for being with us tonight. It's great to have you back on the show and sharing your expertise on this important issue.
Thanks, Mike. It's always great to be here. So, a few key points about inflation that I'd like to focus on today, or this evening rather. The first is that inflationary pressures are evident across the globe. It's not just a US phenomenon. We're seeing prices rising for commodities, for producers, consumers, and even asset prices such as housing prices and even financial markets. For the most part, the inflation that we're seeing for consumers is a function of supply as well as demand factors. And some of these effects we believe are transitory, while others are probably more persistent. And the key thing is that central banks are actually taking notice. On the next slide, here we just have a few indicators here across the world with major regions, the US, China, and the Euro area. And we can see that businesses are complaining about backlogs of orders amid the pandemic, as there's been very strong demand for goods. And that's something that's been quite persistent over the last year in both the US and the EU, not so much in China, but certainly inflationary pressures are exerting themselves as a consequence of these backlogs. And we're seeing prices and PMIs for the US and China, and even inflation expectations among industry members in Europe are all elevated. So, excuse me. So what's going on here? Next slide. We have a picture of commodity prices. They really rose very sharply earlier this year. They look like they're coming off a bit, but they're still rising at a very robust clip. And so that is translating into higher costs, input costs for producers. And over here on the right-hand side, we have producer price indexes in the US, China, and the Euro area, and they have all spiked. And it looks like we're getting a little bit of a respite in the most recent data. It's not clear if we've hit a peak, but certainly with commodity prices, especially for food, energy, and metals rising rapidly, we could potentially continue to see upward pressure on producer prices. The next slide gives us a sense of what's going on with consumer prices and as well as housing prices. So overall, consumer prices for both advanced economies and emerging markets are rising pretty rapidly, more so in advanced economies relative to emerging markets. But still in all, prices are rising for that consumers, ordinary people, are seeing. And we're also seeing house prices increase. Some of that's a function of very low interest rates, remote work, but also the fact that the input for building houses have gone up, such as lumber and steel. And so those prices are being passed on along with the frenzy that we're seeing in terms of desire for people to buy houses. On the next slide, we have global inflation. Well, we have, again, consumer prices for China and the Euro area. The thing is that, yes, in China, we're seeing producer prices rise, but it's not necessarily translating as much into consumer prices. And indeed, overall, and even excluding food, prices in China are still pretty subdued. But we did see a little bit of a pickup. And certainly, there's much concern that there's going to be a translation of those higher producer prices onto consumers in China. In Europe, kind of a similar story where headline inflation is rising and it's now above the ECB's 2% target, but core prices are remaining pretty subdued. That's not necessarily what's happening in the US, and we'll talk a little bit more about the US in a second. But I did mention that even among emerging markets, we're seeing higher prices. So, for example, in Turkey, Russia, and Brazil, prices have creeped up. And as a consequence, central banks have responded. So here's a chart of the degree of monetary policy tightening. And you can see Brazil, Turkey, Russia, and also Argentina have already hiked interest rates in order to help quell inflationary pressures. So what's going on in the US? Well, similar things. We're seeing very high producer prices. That should be chart number 9. Sorry, I don't know if I've been accurately indicating which charts we're looking at, but we're looking at chart number 9 right now. And producer prices in the US are rising, both for things that are probably more transitory, for example, truck and transportation and containers. A lot of that's a function of backlogs, both in terms of businesses not being able to produce enough, and then when they are producing, getting those products to consumers. And a lot of that's a function of the pandemic, and it's probably going to pass. But then you have higher prices for things like lumber and plywood, and also for chips, given the fact that lumber producers in the US are indicating that they're not looking to lower prices, they're just going to collect rents on this. And meanwhile, you have this global chip shortage. And some major producers of chips are saying that this could be a problem well into 2023. So there's still potential for those prices to continue to rise and place upward pressure on inflationary gauges. On slide number 10, here we have components of the PCE deflator, the personal consumption and expenditures deflator. And this is the measure that the Fed likes to look at. I know a lot of folks look at CPI, and that's also correct, but the Fed tends to look at the PCE deflators. And here you can kind of see over the course of the pandemic, which indicators or which components of inflation have been the strongest. And so certainly when we look at goods, which is the chart on the left-hand side, you saw very negative inflationary pressures from energy last year, as well as clothing. People weren't looking to buy clothing. But as things started to improve, and also as we saw changes in demand and supply of energy prices are now big contributors to inflationary pressures for overall consumer prices. And we're also seeing that, surprisingly, but also unsurprisingly, prices for motor vehicles and parts. Motor vehicles, both new and used cars, are very expensive, and that's a function of the fact that many people sought to buy cars last year, and meanwhile, it was very difficult for manufacturers to produce cars because you had shortages in chips and parts and all sorts of things, and so prices for cars have really jumped. And when we look at services, it's interesting. The light blue bars show rents or housing costs, which mainly include rents and also the imputed rent for a person who owns a home. Essentially, if you put your home on the market, how much rent you would receive. And those prices were pretty depressed, and it looks like they're about to recover indeed. Meanwhile, we saw a lot of downward pressure on transportation costs and hotels and things like that. But that's all starting to reverse out. We're seeing very strong pressures for financial services, as well as for things like transportation and now hotels and leisure types of items. So, what are some other areas that are that we're seeing higher inflationary pressures? And again, I mentioned that motor vehicles and parts. That's probably and video and audio equipment. Those inflationary pressures are probably going to be around with us because of the chip short for some time because of the chip shortage. Meanwhile, we're seeing higher costs at bars and restaurants and for air transportation. And a lot of that's a function of the evolution of the pandemic, where businesses are reopening, mobility restrictions are being lifted. And so all these businesses are opening up at once. Meanwhile, the input costs like food are rising, and also costs for wages and labor are rising as well. And so that's all being passed on to the consumer. But again, a lot of these pressures on the right-hand side are probably transitory and will fade, but the ones on the left-hand side are probably going to be with us. And as I mentioned, just looking at rents, and I just labeled this OER, but OER is a term in CPI, but really it's the imputed rent of owner-occupied housing. Both of those measures were very depressed during the pandemic, and it looks like they're probably going to normalize. And so that means continued upward inflation pressures. So what are central banks doing? Well, the Fed is certainly paying close attention, but I think that there are key circuit breakers that will cause the Fed to blink. And we've already seen the Fed blink a little bit in terms of now it's talking about tapering, whereas before it wasn't even beginning to thinking about talking about beginning tapering of quantitative easing and consequently raising interest rates. So I think there are a few really important metrics that the Fed's going to be looking at. So, for example, market inflation expectations, which is chart 13. Here, on the on the left-hand side, we have 5-year nominal Treasury notes minus 5-year tips, or that's the break-even measure, and it seems to track pretty well with the core PCE deflator, and that's just basically all prices in the PCE deflator less food and energy. And so market expectations have risen. However, when you look at consumer expectations for inflation over the longer run, which is the chart on the right-hand side, that navy blue line shows that they're still pretty low, right? The level is still pretty low relative to history, even though the delta or the change that we've seen over the last year and a half has been pretty significant. So at least for the Fed is probably still saying that even though market expectations for inflation have risen, consumers' long-term inflation expectations still remain low. So maybe we don't need to act too quickly. On slide 14, the Fed is also going to be looking at labor market slack. And so the Fed has this broad and inclusive mandate around labor and full employment, So they have this broad and inclusive full employment mandate. And so that means that they're not just looking at the headline, which is the U3 on slide 14 on the left-hand side, which is that navy blue line, but they're looking at alternative measures of inflation. So for example, how many Black or Hispanic persons are still unemployed? And if those gaps are still big, the Fed is saying that we still haven't achieved substantial further progress in terms of looking at tapering or raising interest rates. The Fed is also going to be paying attention to the Phillips Curve, which is basically a relationship between changes in the unemployment rate and inflation. And basically what this chart is telling us is that the gray area, the gray dots, that was kind of the span of very low inflation from 1995 through 2021. But then these little red dots are the latest readings, April, May, and June, which seem to have popped up into the regime that more resembled 85 through 94. So are we in a new inflationary regime, or are these just, really transitory measures of inflation that are going to calm over the course of the next year? On slide 15, the Fed is also going to be looking at drivers of growth and understanding whether or not growth is being driven by domestic demand as opposed to lots of federal government stimulus. And also, the Fed's going to be taking into account the output gap. Various measures of the output gap over the next year or so indicate that there's going to be a positive output gap. So that means, tightening in activity. And if you have that going on, then you might feel safe with raising interest rates. Two more inflation circuit breakers are wages. So this chart on page 16 on the left-hand side shows the employment cost index growth over the last few months, and it's really been aggressive for a number of sectors of the economy. And again, some of these things we can tie directly to businesses reopening all at the same time as people are engaging in in-person services, while other things may be a little bit more persistent. So it's really important to understand if we're going to be in this inflationary spiral where right now businesses are passing on these higher wage costs to consumers through consumer price inflation, but does this lead to more consumers who are also workers asking for higher wages and consequently creating this negative inflationary spiral? And then finally, another circuit breaker is expectations, market expectations, or economists' expectations for when interest rates are going to rise. And for the most part, it seems like the Fed's expectations, at least from the SEP, Summary of Economic Projections, are pretty consistent with what street economists are expecting, that by the end of 2023, we will have several rate hikes in tow. But the key thing here is that the Fed more or less has pretty low inflation expectations, which are in this red box, relative to what the street has, which is in this box on page 17. Sorry, I keep forgetting to tell you in advance. But on page 17, I've circled the important numbers here. And we believe that we're going to see even more inflationary pressures as the year gets on, again, as some of those more persistent inflationary pressures continue. But the key thing is what happens next year. Do we see prices fade, or do we see these inflationary pressures to continue? So I'll stop here and hand it back over to Mike. Thanks so much.
Thank you, Dana. Very comprehensive tour of the global economy, and interesting to note that this is a global phenomenon, not just a U.S. phenomenon, which can actually, ironically, have some benefits for the U.S., we might imagine, because all central banks are in the same situation. So thanks. We'll come back with questions soon. Our next guest is Noah Williams. Noah is the Julie Plant Granger Professor of Economics at UW-Madison and the founding director of the Center for Research on the Wisconsin Economy, also known as CROW. His research focuses on macroeconomics, particularly monetary policy, social insurance programs, and financial markets. He's co-authored several papers with Nobel Prize recipients Lars Peter Hansen and Thomas Sargent. He's a consultant at the Federal Reserve Bank of Chicago and a member of the Economic Advisors Roundtable. His research on state economies, which underlies the work of CROW, has been supported by the National Science Foundation. A Wisconsin native, Noah received his PhD in economics at the University of Chicago, and he's been in UW-Madison's Department of Economics since 2008. Noah, it's great to have you back on the show. I know you've been tracking the economic impacts of the pandemic throughout the state and nationally, and curious to hear your thoughts on the specter of inflation.
Okay, great. Happy to join you all again. So in thinking about the topic, I thought about, well, what is my comparative advantage here? And I'm going to talk a little bit more about causes and some of the policy issues. Dana did a good job summarizing the current lay of the land. So if we'll go to the next slide, I'll give an overview of what we're going to talk about. Particularly, I want to think about what did policymakers learn from the 2008 recession? What have we learned more broadly? And how does that affecting where we are today? So in broad terms, fiscal policy, meaning government taxes and government spending, and monetary policy, both interest rate setting and even more and more prominent these days, direct purchases of assets in financial markets, have proven to be useful tools for offsetting demand-side recessions. So one of the lessons I think policymakers took from 2008 and the slow recovery afterwards was that perhaps it's better to do too much, to react very strongly and risk inflation, than to do too little and face persistent unemployment, right? So we had a very long recovery from the 2008 recession, but we had elevated unemployment rates for years at a time, and they continued to fall until 2019, essentially. So in response to the COVID recession, the COVID pandemic, we had an unprecedented fiscal stimulus response. There's been $5.2 trillion in federal spending, with more on the way. There was just an infrastructure program basically passed by the Senate. There's additional programs or proposals in the works. In addition, we've had continued monetary stimulus. So the policy rate was very low, actually heading into this recession, was cut again to zero. The Fed engaged in, again, continued and stepped up its dramatic asset purchases, including, perhaps surprisingly now at this point, continued strong intervention in the mortgage market. Right, so we think about where the housing market is, the rapid growth in housing prices. The Fed is still intervening there to prop up the housing market. So we had very strong fiscal response, very strong monetary response. These have proven useful to offset demand side factors. Right, so in essence, if people aren't buying enough, the government can step in and provide some additional demand, but they're less useful for offsetting supply shocks. And I think that's maybe more of what we're facing going forward. So thinking about this, I wanted to step back and go to the next slide. Talk a little bit about how would I talk about this, the problem we're facing in an intermediate macro class. So unfortunately, we're jumping right here into the middle of intermediate macro. We don't get to this till a few weeks into the class, but we'll try to walk things through. So what's shown here is just a depiction of equilibrium in an economy. So there's three lines on there. The blue one, we'll think of that as output demand, or it's sometimes called an IS curve. And think about that as kind of the demand, both on the part of households and the government for goods. The red line is output supply. And think of that as what we're producing, and that's really reflective of the labor market and production. And then the green line, we'll think of that as equilibrium in the financial market. So think of it's a LM curve. So think of that as money supply, money demand, and interventions in financial markets more broadly. What's shown here is, stay on that one. In the long run, we have intersection of all three curves. So we have output and interest rates, and we have three curves intersecting. What's not shown there is the price level. So the price level is going to be changing over time, but maybe slow to adjust. All right, so think about that's where we were, say, at the start of 2020. Okay, next slide. What happens when we enter the COVID recession? Well, we have people pulling back from economic activity. We have mass shutdowns. We have people thrown out of work. We have a huge demand side shock. So that's the dark blue line shifting back. In addition, we have supply disruptions, right? We have businesses shut down. We have people thrown out of work. We have lower supply. So that's the red line shifting back. So in the absence of any intervention, what would we see? We'd see a big drop in output. So you can see that with output moving to the left on the bottom. So what did policymakers do in response to that? Next slide. Well, as I've talked about, we had massive fiscal response. So that's the increase in government spending, right? So we had several rounds of direct rebate checks. We had the government providing funds to state governments. We had increased unemployment insurance benefits, all of that going towards propping up incomes and propping up demand. So we have a big offsetting response in demand. At the same time, we have a loosening of monetary policy, right? So we have the Fed cutting interest rates to zero. We have them continuing and stepping up asset purchases. So both of those responses have led output to increase. All right, so a lot of commentators thinking about the current economic situation, I think, have a framework like this in mind. Larry Summers, the former Treasury Secretary and president of Harvard, has been a prominent commentator on this, who's argued that the response has perhaps been too big. All right, so we faced a demand shortfall, but the size of the fiscal response has essentially undone that and then some. At the same time, we've had expansionary monetary policy, right? So I've talked about the government is stepping in and propping up markets, which actually seem to be the Fed propping up housing markets, where we're seeing housing prices rise dramatically. So we have an increase in government spending, a loosening of monetary policy that's leading to an increase in output. But if you notice there, if you look at the thick blue line, which is the increased demand, the thick green line, which is the increased, the loosened monetary policy, those don't intersect. We're still facing supply side factors. This red line shifted back. And so something has to give. And that's the next slide. Prices have to adjust. So that's what we're seeing right now. So we're seeing demand outstripping supply. These policy effects are useful for offsetting a demand side shift, but less so for responding to supply side factors. What we've been seeing then is an increase in prices, essentially pushing us back towards something like an equilibrium. So again, that's how I would think about it in an intermediate macro class. Right, and the key questions is, how long is this process going to take? How persistent are these effects going to be? Of course, a simple diagrammatic analysis like this won't get you those answers, but I think that's useful for thinking about both where we come from and some of the factors driving things. Next slide. So we are seeing inflation, we are seeing price changes, but that doesn't necessarily mean ongoing inflation. Right, so we have an adjustment process in response to policy and the shocks we're facing, which could just be a one-off, right? It could be the transitory inflation that the Fed has been banking on, not necessarily ongoing, continuing increases in prices. What could cause this inflation to become persistent? Well, if policy continues on this path, right, we're possibly setting up a game of chicken between fiscal and monetary policy. We're continuing to run very expansionary fiscal policy. Up until now, we haven't tightened monetary policy either. Although, again, as Dana mentioned, they're starting to talk about that. But we're still at least proposals for continued fiscal expansion. So that perhaps sets up a conflict between expansionary fiscal policy and will we have a tighter monetary policy in response. In addition, so far, and again, Dana talked about this as well, what can cause inflation to become persistent? Well, if households and businesses build in higher inflation into their long-term expectations. If businesses require greater rates of return to make investments, households require ever-increasing wages in order to work and when they renegotiate. So if that gets built into the system, it's very hard to wring inflation out. We've seen a little bit of sign of that, but again, it's kind of early days, and we don't know whether inflation is going to be persistent there. Finally, I should mention all of this, against all this backdrop, there are some long-term deflationary trends we're facing. So the COVID recession has actually led to substantial productivity improvements. We've seen output come back to pre-pandemic levels, but employment is still down, so output per worker has gone up. That normally would lead to reductions in prices. We see global price pressures as well. Increases in retail activities, online purchases, all of those limit the availability or the ability of firms to increase prices. Longer term, we're seeing declining population, falling real interest rates. All those point to, excuse me, the pre-pandemic deflationary environment that we were in. So that still kind of remains our underlying benchmark, our underlying baseline. But on top of that, we've added these shorter term pressures. Next slide. So I won't go over this a lot because Dana actually talked about some of this as well. This is the latest New York Fed survey of expectations of inflation, and they did see a jump up in the last couple months. The New York Fed survey, people are now starting to build in higher inflation expectations, 4.8% 1 year ahead, although still somewhat lower, 3.7% 3 years ahead. Next slide. But what's important to note is that inflation expectations seem to be more correlated to current inflation than really forward-looking. Meaning, people are forming expectations going forward, but they're really influenced by what's going on today. And you can see that here where this is plotting over a longer span, the Michigan survey of inflation expectations, which is the blue, and actual year-over-year changes in prices, which is the red. If people were fully rational and forward-looking, these should be out of phase, but you see they line up pretty well with each other, meaning that an increase in inflation tends to lead to an increase in people's expectations of inflation. Moreover, what do we see? Well, if you look at the very towards the end of that, you see the blue line above the red for a long time. Throughout the post-2008 period, people expected higher inflation than was actually delivered, so people were slow to move inflation expectations down. So all of that suggests that inflation expectations can be sticky, they can go up, but remain high for a while, which means that this process of inflation may take longer to abate than perhaps people expect. Next slide. But again, we're not really seeing the market pricing in much inflation yet, which does suggest that at least market participants, Dana mentioned the 5-year break-even rate is 2.5%, which is, above the Fed's 2% target, but not very far out of line from where it's been. May want to factor in the risk premium there as well. So it's really not, it certainly has increased, but it's not out of line with the historical record. But I just want to leave with perhaps one sobering warning. The market is not pricing in inflation yet. Next slide. But markets can be calm until they're not. Right? So this is perhaps a little bit, provocative. But what's shown here is interest rates in Germany and interest rates in Greece. You look at what happens early on, 2008, 2009. Greece was running very large fiscal deficits, but there was essentially zero interest rate spread. So markets at that time were not pricing in the probability of a Greek default. And what happened very rapidly thereafter, the Greece situation took a turn for the worse. So situations like this can persist for a while until they don't. And what I like to think of there is a famous quote from Hemingway. Someone asked in The Sun Also Rises, how did you go bankrupt? 2 ways, gradually and then suddenly. So we may be in the gradual phase now where markets are slow to react. Not saying that we're going to enter into a situation anything like we saw there, but it at least is a possibility that we have to keep in mind for thinking about the long-term, particularly fiscal situation. All right, I'll leave it there.
Great, thank you, Noah. And that's probably one of those where there is a bit of safety in numbers because you're comparing Greece with Germany, who had a very stable monetary policy. Right now, we're pretty well coordinated with the other developed economies in our monetary policies. So not those big gaps likely to open up, but still take your cautionary note seriously. Thank you. Final guest tonight is Mike Stohler, the incoming Chief Investment Officer at the Wisconsin Foundation and Alumni Association. Prior to joining us, Mike served as the Managing Director of Investments at Washington University Investment Management Company, where the team oversees an endowment well over $10 billion. Prior to WashU, Mike worked in multi-asset class portfolio management with JP Morgan Private Bank, but he began his career as a high school physics teacher in Indiana, decided quickly that maybe he was more suited to college students, got a PhD in physics at Purdue, at which point he became fascinated by investments, which is a bit of a family tradition, as I understand it, and then went on to get an MBA at NYU and joined JP Morgan at that time. Mike, it's great to have you on the program and give you a chance to talk to our alumni a little bit. And obviously, we've covered a lot about where the inflation's coming from, and I was hoping you could tell us a little bit how do you think about inflation and especially uncertainty about inflation from an investment perspective? So, Mike, the floor is yours. You might be muted on your device.
Thank you, Mike. I appreciate being here. Love the opportunity to be able to engage everybody this evening on the kind of market outlook and thoughts about the endowment pool. I think, though, it maybe makes sense to start by contextualizing the Foundation's endowment. I think it's important to note that the majority of the capital that we manage is perpetual, with a theoretically infinite investment horizon that puts a lot more emphasis on long-term structural growth trends rather than trying to make short-term market calls. So, with that being said, what we try to do is build a robust asset allocation framework that can weather all parts of the market cycle to ensure that there'll be support for future generations as well as current needs. However, we do need to be sensitive to the market environment when deploying capital and rebalancing, as well as navigate extreme market conditions like ones we could be confronting here in the next few years. As of yet, as Noah just told us, the market has a relatively benign view of the potential for inflation here, even in the face of fairly hot-looking CPI prints, including the 5.4% in June. The July numbers actually coming out tomorrow, and there'll likely be some noise there as well. But unless there's some significant change to the narrative, markets are pretty likely to ultimately look past that print as well. There are a handful of reasons that explain why the market isn't too shaken by the recent data, including the fact that results have been heavily influenced by, transient pandemic-related effects that we've hit on this evening. It's also hard to get overly concerned when we're sitting on a fairly significant, amount of labor supply slack with unemployment over 5%, which is essentially Dana's Phillips Curve argument. Moreover, an aggressive policy response by the Fed is not guaranteed, even in the event that structural inflationary forces are identified. In the case of demand or wage-driven inflation, especially one that actually benefits the middle class, the Fed may have more of a dovish policy response, given decades of labor share decline. And lastly, given the global context, the Fed has shown a relatively unified front with international counterparts, and the ECB has recently adjusted their policy targeting to be more accommodative. So with all of these issues in the mix, our base case includes only modest, persistent inflationary pressures with the potential for a moderate rate response, consistent with Noah and Dana's comments. There are a couple of other things to keep in mind, though. Given the fact that we are a mostly equity portfolio, we have a natural buffer, an inflation hedge built into the asset allocation. We have roughly a 80-20 stock bond gearing. The endowment pool benefits from the fact that both public and private equities have historically been a powerful long-term hedge for inflation. Big picture, what's happening is, over a moderate time horizon, corporate revenues tend to absorb inflation, and that passes through to market performance. Of course, in the medium to short term, if we do see some inflationary pressures that spooks the market, multiples re-rating will be uncomfortable for a lot of market participants. If that leads to an event of over-responsiveness by participants, I see that as an opportunity to deploy additional capital. There are a few charts here that, so skip a couple of slides in. that I think are helpful. One, this first one should look familiar to you. It is putting the current CPI prints into a longer term perspective. I made sure to include the 70s environment where stagflation ruled the day. I'm not trying to draw a parallel between the current environment and what we were facing then. We had sort of a double whammy of both a food and energy shock, which led to a double-digit inflationary spiral that ultimately required some serious rate surgery from Chairman Volcker. The larger takeaway from this slide is that the recent CPI run rate is far from extreme and fits into a larger volatility context. Next slide. The second chart is me just highlighting that 5-year break-even number for TIPS. So this is, in my opinion, the most direct way that the market is telling you what its expectations of inflation actually are. And what you're seeing is expected inflation by the market that's somewhat consistent with the Fed's policy target of 2%. And this is similar to what you heard from Noah. You can see on the chart, you see that in March of 2020, there was a collapse in inflation expectation as the market digested COVID-19, but you also see the quick recovery from there. I'll also point out that TIPS, in terms of being an investment tool that we have access to, are operating in the negative yield territory. So while they help you capture inflation if you have a particular view, they're kind of a tough asset to hold in the current market environment. The next chart, the third chart that I think is important for the discussion is a chart that tries to communicate the division between the share of the profit pool between capital and labor. So what you've seen is a multi-decade long decrease in labor's participation in that profit pool. And that's why the comment I make about, inflation being centered on the middle and lower class makes it difficult to have a dramatic policy response and leads into a more dovish policy response function. Next slide. This is a particularly important chart because it tells you what happened through the stagflation of the 70s and early 80s. What I've charted here is inflation, and I'm showing headline, so with food and energy, against the S&P total return. And I think an important question is, even for a low growth, high inflation environment like the one we lived through during that time period, did equities pace with or even beat inflation, i.e., did you maintain real value just by holding on to equities? And of course, the answer is yes, if you're zoomed out at an appropriate time horizon. Of course, in 73, 74, you had an almost 50% market decline, which is not comfortable for anybody to survive through. However, I think the lesson there is folks who held on to their equity investments through that time period ultimately benefited from staying put. So for me, this is a reasonable demonstration of the equity market's ability to absorb price instability and a good reminder to stay invested. Next slide. The fifth chart is a comment on currency. So currency has been, somewhat responsive to inflation expectations. The endowment has north of 20% of its capital in non-dollar denominated assets. And those non-dollar denominated assets are a natural inflation hedge. So if there's localized acute domestic inflation, dollar should weaken, which makes foreign investments in foreign denominations compelling. Next slide. Because of the base case and central viewpoint here, the endowment has not made significant adjustments for inflationary risks. That being said, if that view were to change, there are some things we want to think about. So next slide hits some of those thoughts. So first of all, no matter what you do, you have to compare how your evolved market thinking compares to what's priced into the market. So if your thinking evolves along with the markets, you may not be able to kind of get out of the way with sufficient time. That being said, I think it's a good idea to go through the exercise of imagining you had a crystal ball and you could get ahead of the market in terms of your investment planning. What would you do? First of all, I think it's important to highlight that fixed rate, fixed income is going to be pretty challenged in a high inflation environment. So that's a part of anybody's asset allocation that probably should be revisited in a situation like that. There are fixed income alternatives like TIPS and floating rate investments that could make interesting alternatives. But both categories, primarily levered loans for floating rate, have their own challenges, and so you'd want to talk to somebody specifically about investigating those options. A more interesting solution, and this goes back to some of Dana's comments, is to invest in real assets as a way to hitch your exposure to things that are going to be more responsive and have a high degree of pass-through on inflationary pressures. Those assets tend to have a different risk profile relative to fixed income, so probably should be funded by a combination of stocks and bonds. And it would be preferred to invest in those real assets, both commodities and real estate, directly if possible. Proxies are also useful tools. So think REITs or energy equities. Those kinds of investments make good proxies for real assets, but come with significantly more mark-to-market and basis risk. Lastly, in terms of equity positioning more broadly, it's important to highlight the fact that if inflationary pressures do become a problem, not all parts of the equity market are going to respond the same. Any investments that have cash flows further out will likely pay more of a penalty in terms of repricing because the discount rate that you need to use to adjust your model just got a lot bigger. So that makes revisiting a growth versus value split inside any portfolio a really interesting exercise. That being said, value stocks have not really worked since 2007, and most investors are sitting on portfolios that are probably dominated by growth equities. So that's a discussion or conversation that people probably should be having anyway. So those are the biggest tools you have in the portfolio toolkit. If you were to go above and beyond that and come up with a trade that really captured the effects of inflation on both sides, you might do something like, and this is not something the endowment would do, but an interesting thought experiment would be to capture your view on rates by actually borrowing capital at fixed rates and then going long either real assets or, if there is a market re-rating within equities, shopping for great companies with terrific management teams that have long growth runways that you want to hold over the long term. and bottom fish during that period of time. So with that, I'll turn it back over to Mike.
Well, thank you, Mike. Great to hear your insights on the impact of inflation on the investment climate, especially across all the asset classes. We don't have a lot of time tonight for Q&A, but one of the things I wanted to ask each of you to comment on, we've alluded to, I think, a number of ways that the Federal Reserve has tried to prepare people for the idea that there would be this temporary surge in inflation. They began talking about it well in advance. They predicted we would be here. And I think of that as one way to try to reduce the likelihood that people really embed this inflation into their long-term expectations, right? The Fed has kind of been doing some jawboning to get people to think, oh yeah, this is just temporary. We knew this was coming. But of course, there are reasons why it may not be. And we've also talked a bit, you've all alluded to some of the other criteria that the Fed looks at, maybe the broadening of the Fed's mandate. What kind of grades do you give the Fed in how they've performed to this point during the pandemic? And what do you worry about, say, over the next 6 months? And Dana, I'll start with you, and then we'll go to Noah and Mike in the order that we went tonight.
Sure. I think I would give the Fed an A-. Certainly back in March of 2020, when financial markets seized up, it made absolute sense for the Fed to go all in and be very aggressive, just given the memory of what happened in 2008. So that made a lot of sense. I think the Fed, probably gets an A- in terms of communications, where, it broadened its mandate, and that was communicated very clearly. But the mandate itself, like, what does it mean for inflation to be slightly above 2% for some period of time, right? And what does substantial further progress mean? These are very vague terms. And so to that extent, it's very difficult for markets and certainly, regular people to really understand what the Fed means. And indeed, the Fed has said, a lot of this is transitory, meaning temporary. It's going to pass. But what do you do about companies that are saying, food companies that are saying, we're going to raise food prices, right? We're going to raise them again and again. And on the other hand, you have chip makers saying, we're not going to have chips for another 2-3 years. So I think the Fed needs to also talk about some of those more persistent elements of inflation in its communications.
Noah.
Yeah, I think I largely agree. I'd maybe say a B, a little bit worse. I think they are a little bit behind the curve on this. In some ways, it was probably unfortunate timing to be rolling out the new decision-making framework at the same time that the pandemic hit, with the average inflation targeting, which I think really has probably limited their ability to react. I mean, I mentioned it in my talks, but I still think it's crazy they're intervening in the mortgage market now, given the way housing has gone over the past year. I think they're very scared to pull back from any of their market support, scared of any short-term turmoil. So along all those lines, I would probably downgrade a little bit. But overall, I mean, I think the performance has been strong. I mean, we've come out... we've recovered quite well, in a relatively stable environment. But I guess I'm concerned about risk going forward.
Well, the Fed has done better than I did on your intermediate macro midterm just now. So, Mike.
I have to do B plus A minus, right? The Fed in general has been very investor friendly. The name of the game here is credibility. And the market, I think, believes that they have a great partner in the Fed. And so that obviously has fueled multiples. But I think in terms of battling inflation from here and next steps on getting out of all this, I think the market feels pretty comfortable. So that ultimately is what I care most about. So
what do you... Is anyone concerned about the future of fiat currency? We've had some commentary coming in. Central banks around the world, the first time in my lifetime, have really been extremely aggressive with their balance sheets. And at the same time, we have these new currencies cryptocurrencies emerging off on the side, creating an alternative mechanism for people. Do you worry at all that all this expansionary behavior is ultimately going to accelerate some of these other alternatives to traditional currencies? And would that be harmful, or would that be a good thing? Noah, let's start with you, since you did that tough exam.
So I guess I'm ultimately not concerned in the short term about the fiat currencies going away. I mean, ultimately there's a lot of demand for safe assets, which still, even given the problems the U.S. faces, means U.S. treasuries, and that's ultimately backed by U.S. currency. So I don't see that changing in the near term. I am concerned about, as I mentioned, about our long-term fiscal situation. But I think that'll set up a reckoning, but that's several years, decades down the road. But it's something to keep in mind.
Dana?
Well, I guess when I think about the balance sheet, you're creating reserves, and the key thing is, where do these reserves go? Do they just remain, in the coffers of banks, or are they actually lending it out, right? And if they're not lending it out through the credit process, then you're not necessarily creating inflation for consumers. So that kind of addresses that argument. But I'm very concerned about asset prices, where very easy fiscal and monetary policies are encouraging prices to rise, right? Because they're expecting that the punch bowl is going to remain forever, right? And that's never going to be taken away. And at some point, it has to be. You have to come back to some sort of equilibrium in terms of Fed policy and in terms of sustainable fiscal policy. So I guess I'm with Professor Williams in terms of having concerns about the long-term fiscal outlook, and certainly concerns about the Fed being independent from Treasury, and in terms of making sure that the Fed isn't adjusting policy or keeping policy in a certain way to facilitate larger deficits down the road.
Quantitative easing coordinated across all the central banks around the globe has worked remarkably well, in my opinion. Why do we have to take the punch bowl away? You alluded to the need to do that. And I guess I would just ask, why can't the party go on?
I guess that's for me, huh?
You brought up the punch bowl.
Well, the thing is that interest rates are at the zero lower bound, right? And so they can't remain there forever, because over time you're going to, and plus you have the Fed distorting the Treasury market by placing its thumb down on longer term assets, as well as the short end of the curve. And so all of this is distortionary, and you can invoke inflation. You can encourage governments, and in the U.S. case, the U.S. government to continue to borrow because interest rates are so low. It just creates all these distortions that must be worked out over time. And you could either work them out slowly, or you can have some event and all these problems crop up at the same time and cause disruptions, not only for markets, but also for Main Street.
Kind of like Noah's last slide, I guess. Maybe we get to that point where something really bad happens. But, again, with coordinated bank intervention, it seems to have worked much better. I would say our policy could have never led to such, I guess, constructive results over the last 12 years if it hadn't been that other central banks did the same thing. I think we would have entered that world that Noah talked about, where we might have had a currency crisis. Jim Kennedy wonders whether there are any sectors where we aren't seeing inflationary pressures. Are there some parts of the economy? Noah, you alluded to some, technological innovation. Is that keeping prices stable in certain areas?
Yeah, actually, Dana may have more of the data on the disaggregated time series, but I mean, I was thinking manufacturing overall has performed reasonably well throughout this. I mean, I was talking about kind of the longer term trends with Amazon, et cetera, kind of keeping overall retail prices in line, and limiting ability of individual companies to raise prices.
Dan Olszewski wonders if any of you have any predictions regarding when we might see 10-year rates get back to historical norms, or at least over 4%. And Dan, I know you're not thinking of retiring, but maybe you would like to have a bond portfolio that did something. Any thoughts about that, Mike Stohler? Are we going to be back to a normal like that at any point in the next decade or so? Or is that just due to these long-term deflationary forces, we just won't ever get back to sustained 4% 10 years?
Mike, that's a pretty unpopular opinion, at least in my circles. The path to get there is a path of growth, right? So we've got to grow our way to normalcy. So we've got to, in the medium term, figure out how to produce that, across the economy, so that we can get there. Like we can grow our way out of the punch bowl problem and get to a more normalized rate environment. But that's the only way I see us being able to make that happen.
Dana, any thoughts about that?
I don't forecast a 10-year.
All right. Fair enough. Well, I might have to change your bio, because you do give commentary about rates.
In my old job.
All right. So Noah, do you I know you think a lot about the real economy. Do you think we'll have, real rates and, kind of a normal inflation rate that could get us to the 4% 10-year anytime soon?
I mean, the optimistic scenario would be some of the productivity improvements that we've seen, and we have seen a ramp up in new business formation, which we hadn't seen for decades. So if that actually takes hold and we do see sort of a new era of growth going forward, you think 2% growth plus 2% inflation gets you to 4% nominal rates.
Fair enough. Well, Dan, there's hope. Maybe we can retire someday. I'll give you all a chance for, any final comments about your thoughts about inflation or just the economic outlook generally, as we look to close out 2021. Dana, any final thoughts for us about what you think you'll see in not just inflation, but growth for the balance of the year?
Sure, we're still pretty constructive that the U.S. economy is going to continue to expand. More people are going to be engaging in in-person services, but at the same time, you're still going to have these inflationary pressures on consumer prices as well as on wages, and also potentially still slow go in terms of labor market healing. But overall, we're pretty positive on the U.S. outlook.
Noah?
Yeah, I guess I'm a little bit less positive than I would have been about a month ago, given the resurgence that we've seen in the virus and the associated public health measures. But nonetheless, I think overall we have to be relatively pleased as to how we've come through this recession, bounce back, at least in terms of output, relatively quickly, and incomes are up, even though the labor market still lags.
And Mike?
Yeah, I mean, I think the Delta variant and the kind of extension of COVID has continued to pull forward demand for tech. And I think there's a ton of innovation that's actually come out of this. So there's some silver lining that I'm going to look to help us through this.
Great. Well, thank you all for taking time on a Tuesday night. Our veterans, Dana and Noah and Mike, thanks for joining us, newest member of our Badger economic and finance community. So wonderful observations this evening, and I'll look forward to seeing you all again very soon.
Great.
Thank you.
And thanks to our audience again. Great questions and very interesting topic. We went through a lot of data today. I hope you did better on the Noah Williams intermediate macro midterm than I did. I'm a little rusty, But great comments. We'll be back again in 2 weeks. We'll probably have a look at some form of, back to school for the fall semester, either what's going to be happening on the academic and administrative front, or maybe even in our athletics arena. But until then, have a great drink in the remains of the summer. Hope you have a wonderful rest of August, and we'll see you again in 2 weeks on Wisconsin.
You can try, but you'll never stop a badger. Because we badgers are born with curious minds and endless heart. When we see a curve in the road, we speed up. When there are mask shortages for first responders, we make our own supply chain. When there's a world on pause, we sharpen our claws. Through thunder, fire, and pandemics, we'll keep going. Because after all, you can't stop a badger.